Hi guys, so the next chapter that we are going to look at is called Audit of Consolidated Financial Statements. You know, as per section 129, we are supposed to maintain consolidated financial statements are being prepared wherever there is a holding company. So let's see how this entire topic works. So we got to talk about what are consolidated financial statements, what are the audit considerations, and how will we deal with the audit considerations, and auditing, how to audit the consolidation, we got to see that, and also we will be looking at some of the special considerations, and finally we'll also talk about how do you go about reporting this, right? It's a very fairly small and simple chapter, let's go by that. So as I told you, we're just starting with the fact that section 129 consolidation is mandatory when a company has one or more subsidiaries including an associate or a joint venture. It shall, in addition to own financial statements, this own financial statements is called standalone financial statements. Now you know what standalone financial statements are. So that is for that one particular entity. So it shall, in addition to own financial statement, prepare a consolidated financial statement of the company and of all its subsidiaries in the same form and manner as that of its own. Same form and manner as that of its own is nothing but, see, you are preparing as per schedule 3, right? So same schedule 3 format you got to prepare now a consolidated financial statements. So what are consolidated financial statements and how are they being prepared? Something that you have to see. Central government may on its own or on an application by class of company that exempt. So this is for the case where exemptions are seeked up. Central government may on its own or an application by class of companies by notification exempt any class or classes of companies, any class or classes of companies from complying with any of the requirements of section 129 or the rules. So that is up to the central government to let you do that, okay? So that's the first and foremost thing. As per section 129, we are now looking upon what exactly are consolidated financial statements and how will we talk about it, right? Let's discuss that a little deeply in this chapter. According to the Companies Accounts Rules 2014, the consolidation of financial statements of a company may be made in accordance with the Schedule 3, provisions of Schedule 3 of the Act. However, a company which is not required to prepare consolidated financial statements in the accounting standard, it shall be sufficient the company complies the provisions of consolidated financial statement provided in Schedule 3 of the Act. So what is it saying? A company which is not required to prepare consolidated under accounting standards. If you are not supposed to prepare consolidated as per accounting standards, you don't fall under that definition, but you fall here, then you might prepare it as per Schedule 3, that is enough. Consolidated financial statements are presented for a group of entities. Obviously you know that if it's a sole standalone company, then it is not needed. For a sole group of, a whole group of entities under a control of a parent. So I hope you know the story. Let me quickly give you an example here. Let's talk about some company called A Limited. Now A Limited's holding company is H Limited. A Limited has a subsidiary called S Limited. A Limited has an associate called AC Limited, something by name, and then a co-subsidiary. So all these are there, right? Now A Limited obviously has to prepare financial statements consolidating this and this, that is 1, 2, 3. It has to consolidate anyway. H Limited is the holding company of all, right? This is called the, now S, parent company of S is A Limited. A Limited's parent company is H Limited. So H Limited is called the ultimate holding company. So H Limited has to prepare a consolidation of all of this. That's how it works, right? Consolidated financial statements are prepared for a group of entities under the control of a parent. Who's a parent? A parent is an entity that has one or more subsidiaries. I hope this example clarifies who's a parent. H is a parent of A Limited while A is a parent of S Limited. A group comprises of parent and its subsidiaries. The whole thing of this under H Limited is called the group because the group contains the entire bunch of people. Consolidated financial statement. Now when you say you're preparing consolidated financial statements, what is that about? Consolidated financial statements normally include a consolidated balance sheet, prepare a consolidated balance sheet, consolidated P&L, notes, and also a cash flow statement. So nothing new. As part of normal definition of financial statement, whatever you see, consolidate also as a balance sheet, P&L, notes, and a cash flow statement. Now very important point is quickly to understand non-applicability. To whom consolidated financial statements are not applicable. I hope you know from section 129 you already discussed this in law, and of course obviously you must have discussed in your inter as well, right? Section 129. So let's see that once again quickly. A wholly owned subsidiary or its partially owned subsidiary of another company and all its other members, including those not otherwise entitled to vote, have been intimated in writing, and for which a proof of delivery of such information is available. Proof of delivery of such information is available with the company. Do not object the company not presenting financial statements. So where if there is given it in writing and it is told to the members that it is intimated in writing, there is a proof of delivery to each of them saying that we already told them that we will not be preparing consolidated financial statements, then that is also something that you don't really have to worry about. Then 2, a company, what about a company? A company whose securities are not listed, or not in the process of listing in any stock exchange, whether in India or outside India. Now this is a very important point. Ultimate or any intermediate holding company files consolidated financial statements the registrar which are in compliance with applicable accounting standards. Like in the previous example, now when anyway you see that H Limited is going to prepare financial statement because it is the ultimate holding company, A Limited need not consolidate S Limited and prepare. Got it? So S Limited is a subsidiary of A Limited, but anyway A Limited is a subsidiary of H. So H will anyway prepare a consolidated financial statements of all of this. So therefore A Limited need not prepare, which is again an intermediate, in between. So where is that point number 3? Read that carefully. Ultimate or any intermediate holding company. So if it is already, intermediate means in between. So A Limited obviously is a holding company of S Limited, but is an intermediate, in between, right here. So this one is intermediate, and anyway intermediate company, even if it prepares, still it has to be consolidated with the ultimate parent company, right? So anyway, since they are doing it, you don't have to do it. And an investment entity need not present consolidated financial statements if it is required in accordance with para 31 of Ind AS 1110 to measure all of its subsidiaries at fair value through P&L. A parent shall determine whether it's an investment entity or not. I hope you read Ind AS 110, and if you have already read that, you understand this. So an investment entity, whoever is classified as an investment entity, that need not prepare consolidated financial statements. What is an investment entity is also explained that. Let's see once again here. An investment entity is an entity that obtains funds from one or more investors. From whom? Obtains funds from one or more investors for the purpose of providing those investors with investment management services. It obtains funds from one or more investors for purpose of providing those investors with investment management services. So you are taking money of others just to do investment management. Their money you are managing. Or it commits to its investors that it is business purpose is to invest funds solely for returns. You are not taking that money and doing something, you are investing that money solely for returns from capital appreciation, investment income, or both. So you put that money, capital appreciation, investment income, or both. That's all. That's what we are talking about. And it measures and evaluates the performance of substantial all of its investments on a fair value basis. Measures and evaluates the performance of substantially all its investments on a fair value basis. So when it's already measuring at fair value basis, then also an investment entity, it becomes an investment entity. And to tell you that from the previous slide, an investment entity need not prepare consolidated financial statements. Having said that, however, like normally I've told it multiple places, It's once again I'm just repeating it, but it's just not the point all the time. But yeah, nonsense generally starts the word however. So till now they said you don't have to prepare and all of that, but now what are they talking about? So however, as per paragraph 33 of Ind AS 110, parent of an investment entity shall consolidate all its entities. So if you are an investment entity, you don't have to consolidate. But if your parent is there, right? That is, this investment entity is a subsidiary. So there is a parent for this investment entity. So if there is a parent for this investment entity, then definitely you have to consolidate when it is coming to the parent, right? As per para 33 of Ind AS 110, parent of an investment entity shall consolidate all entities that it controls, including those controlled through an investment entity subsidiary. Like this investment entity is holding in another company, that also has to be club, because this parent is not holding directly in this parent is holding stake in this through the investment entity, unless the parent itself is an investment entity, if you understand what we're talking about, right? So if this parent itself is an investment entity, again they don't have to consolidate. But otherwise, if the parent is a normal company which is a parent of an investment company which has made investments, then all of that has to be consolidated as well. Okay, let's now talk about two things. Obviously, responsibility of parent entity, and as auditor, what is your responsibility, which is what the chapter's title is, Audit of. So let's now go ahead and see here as to what is the responsibility of the parent company. First of all, we talk about this word components. You know what are components? Components nothing but branch, division, subsidiary, associate and joint venture. Branch, division, subsidiary, associate, branch, division, subsidiary, associate and joint ventures. Branch, division, subsidiary, associate and joint venture, what are all these? These are all called components. So the first and foremost thing that we need to talk about is identifying components and including the financial information of the components to be consolidated in the financial statements. That's what consolidated financial statements is all about, taking all of those together, identifying components and including the financial information of components to be included in the consolidated financial statements. And not only that, where appropriate, identifying reportable segments for segmental reporting, where appropriate, identifying reportable segments for segmental reporting, and identifying related parties and related party transactions for reporting, right? That's a requirement from Companies Act also, and that's a requirement from accounting standard also. So identify all your related parties and related party transactions. Obtaining accurate and complete financial information, from components, and making appropriate consolidation adjustments, harmonization of accounting policies and accounting framework, and GAAP conversion wherever applicable. Generally accepted accounting principles. So if it's from Indian GAAP, you might want to convert it to US GAAP. It's already in. So like that you might want to convert, and this all are to be done as per the responsibility of the parent company, because again the preparation and presentation of consolidated financial statements is totally the responsibility of parent company. Now going further from there, let's talk about another most important aspect, which is called responsibility of the auditor. Let's see this. The auditor of the consolidated financial statement is responsible for expressing an opinion, which itself clarifies that there is no new responsibility. Again, you are expressing an opinion, but the fact that you are expressing an opinion this time on the consolidated financial statements. The auditor of consolidated financial statements is responsible for expressing an opinion on whether the consolidated financial statements are prepared in all material respects, in accordance with the financial reporting framework, and according to the FRF, that is here section 129 of the Companies Act, and which the parent prepares the consolidated financial statements. So obviously we now saw the duty of the parent company to prepare it. All I am saying is you check whether the parent company has actually prepared it or not. That's the whole point. Therefore the auditor's objectives in an audit of consolidated financial statements are to satisfy himself. Now this again, unless you get sufficient appropriate audit evidence that they have prepared in accordance with FRF, everything is taken care of, then only we can feel happy. To satisfy himself that consolidated financial statements have been prepared in accordance with the requirements of the applicable FRF. That's what you're supposed to do, gather evidence to say that they prepared it in that way. Two, to enable himself to express an opinion, on the true and fair view. We are back to our true and fair view story. To enable himself to express an opinion on the true and fair view presented by the consolidated financial statements. And not only that, to inquire the matters as specified in 143.1. Remember 143.1, 6 specific matters, whether loans and advances have been given based on security, whether book entries are prejudicial, right, those 6 points. And to report to the extent as per CARO. But now one other point, to report on matters given from clause A to I of section 143.3. These are 143 are what? Principal assertions. To report as per principal assertions. Now one more important point is there, read with Rule 11. Rule 11 is the 4 points that are there in 143.3. So 143.1 and 143.3 both are applicable. And of course 143.11 orders made by central government, but 143.11 has CARO. And in CARO it is very clearly told that CARO is not applicable to consolidated financial statements. So you don't have to really worry about that right now. So as an auditor, you got to obtain obviously evidence, then confirm that it is in true and fair view, then answer all these 6 specific matters. And to report on the matters given in clauses A to I, and of course then Rule 11, validate the requirement of preparation of CFS to that company as per applicable FRF. Did they prepare the financial statements as per applicable FRF? And one more important point is, are they needed to prepare? And if they needed to prepare, is it the right way that they have prepared? All this is also something that we have to cross check and confirm. Then alongside this, let's talk about following standards. Of course you got to follow all the standards, right from standard number 200 to standard number 720. Standards on auditing, statements and guidance notes on audit matters issued by ICAI apply in the same manner to the audit of consolidated financial statements as they apply to the audit of separate financial statements. It means that auditors, while conducting the audit of consolidated financial statements, while conducting the audit of consolidated financial statements are expected to plan their work, to enable them conduct an effective audit of efficient and timely manner, obtain an understanding of the accounting and internal control systems, including IT system like consolidation tool sufficient to plan the audit and determine the nature, time and extent of the audit procedures. Obviously you know these points, I guess by now we have seen, we have got to obtain an understanding of the internal control. Without obtaining, that's all part of 315, right? Plan and perform. This is standard number 300 and 315, wherein you're talking about planning and risk assessment. So you do risk assessments where you can assess, the auditor can determine the nature, time and extent of the audit procedures, such as an understanding would help the auditors to develop an effective audit approach. It will help you develop what? An effective audit approach. And apart from that, use professional judgment. Auditor may use professional judgment to assess audit risk, and to design audit procedures, to ensure that the risk is reduced to an acceptable level. You bring down the risk to an acceptably low level so that you don't take much of a risk. You know all these points. Now let's get the major part of the chapter. Till now what we have seen is all the basic intro of this chapter, where we are mostly talking about what we are supposed to do as part of management and as part of auditors. But let's now get to the main part of it. Audit considerations. What should we consider as auditor and what should we pick? It's a very important point. The auditor should assess whether based on his work alone he would be able to express an opinion. Now no problem, because as I told you, the definition of component, which is defined in standard number 600. If you have already watched standard number 600, you know it's branch, division, subsidiary, associate, at joint venture. They have somebody called as another auditor, like the auditor of this branch, division, subsidiary is called another auditor, and we can use or rely on the work as per say 600. So that is what they are telling. You first see whether you can do it on your own. If you can take it up on your own and you can do it on your own, there is nothing like that, you can very comfortably deal with this. But the auditor should assess whether based on his work, so based on your work, the auditor should assess whether based on his work he will be able to express opinion on the true and fair view presented by the consolidated financial statements. And if the auditor is of the view that, what is his view? His own participation may not be enough. It definitely happens sometimes that because there are more subsidiaries, there are more number of branches and all that, you can't obviously do consolidation on, because the reason being very simple: many number of subsidiaries, parent company, and then so many co-subsidiaries, associates, if so many are there, then if the auditor is of the view that his own participation may not be enough, if the auditor is of the view that his own participation may not be enough or sufficient, he should consider using the work of other auditors. He should consider using the work of other auditors. And if he decides so, then he should comply with the requirements of SA 600, which is about using the work of another auditor. As I was just talking about this, using the work that performed by a component auditor is discussed there. So you might want to touch base that and see what is that you are supposed to do as per standard number 600. So keeping that in mind and going further as to what you are supposed to deal with, these are the points. Now again, I believe that you know what is standard number 320. So standard number 320 talks about determining the level of materiality. So what are we supposed to deal with in audit? Let's see this. Come on. Determining the level of materiality. Why should you do the determining level? See, because again the logic is very simple. What may be material? What may be material at a standalone level? What may be material at a standalone level? What may be material at standalone level necessarily need not be material, at consolidated levels. That is why we are supposed to check the materiality again. Now understood this point, because individually when you are talking about that entity, it may be material from that entity's point of view or that component's point of view, but when you are talking from the point of view of the whole, that is the entire consolidation, it may not be material. So it is important that you have a thorough understanding of this. Determination of materiality. Okay, so the auditor is required to compute the materiality for group as a whole, not for standalone anymore, for a group as a whole. And this materiality should be used to assess the appropriateness of consolidation adjustments, that may be made by management in preparation of the consolidated financial statements. The parent auditor can also use the materiality computed on a group level to determine whether the components financial statements are material to the group, so that, and the entire component. Now like say there are so many subsidiaries, that one subsidiary, the entire activity of the subsidiary itself is totally not material. So the parent auditor will use the concept of materiality to determine whether the components financial statements are material to the group, to determine whether they should scope in additional components and consider using the work of other auditors as applicable. The principal auditor also computes materiality. For each component and communicates to the component auditor. The principal auditor also computes materiality for each component and communicates the component auditor if he believes it is required for a true and fair view of the entire consolidated financial statements. And as such, the principal auditor also obtains certain confirmation like independence, code of ethics of the component auditor. These are all points that you can see in essay 600. Now if you are using the work of them, you might want to obtain whether they are independent, because if they are not independent and you are using that work, then it might affect you, right? The principal auditor also obtains certain confirmations from the component auditor like independence, code of ethics and certain information required for consolidation. You can obtain all this from the component auditor. Thus, component auditor's observations, obviously the consolidated financial statements will be bearing on all this, so that is why the component auditor's observations, if any, if at all individually any of them have anything on the component financial statement, irrespective of whether the auditors of component are the auditors of CFS. Now that is the point. You might yourself have audited another component also, that is also there. So it's not like somebody else only has audited always. Sometimes you are only the subsidiary auditor also. So in such cases, thus the component auditor's observations, if any, on the component financial statements, irrespective of whether the auditors of component are the auditors of CFS or not, are required to include it in part of the parent company on the CFS regardless of materiality. Don't bother about materiality for those set of statements, need not be consolidated, irrespective of whether the auditors of component are the auditors of CFS, doesn't matter or not. They are required to be included in the parent auditor's report on the CFS regardless of materiality. Understood? So if there are any observations that are made by component auditors, and whether you are only that auditor or not, if the observation has been made, you might have to make it as an observation here also. Okay, simple point. Component auditor's observations, if any. If component auditor himself didn't make any observations, or you are only the component auditor and you only didn't make any observations, so in that case you can leave it. But if at all anything has been made, then you should not ignore it, irrespective of whatever be the materiality, highly material, not material, all that will not be an issue. You definitely have to report on that. Thus the component auditor's observations, if any, on the component's financial statements, irrespective of whether the auditors of the component are also the auditors of CFS or not, are required to be included in the parent auditor's report on CFS regardless of materiality. So it doesn't matter how material or not material they are, you have to still report such cases where the components auditors have made a point. Then let's talk about auditing the consolidation, important part. Now first and foremost thing, who is the parent? Under this parent, how many subsidiaries are there? Under them, what are the subsidiaries? This entire thing is called as group structure. What is it called? A group structure. Now before you take up anything and do the big audit, first you need to understand that. Understanding the group structure and group wide controls, a very important aspect. Understanding the group structure and group wide controls, including assessment of IT system, and related general applications control for consolidation process. Understanding of accounting policies, understanding of the accounting policies of the parent. Understanding what? Understanding of the accounting policies of the parent and its components, as well as of consolidation process, including the process of transactions of financial statements of foreign components. Obviously, because accounting policies may not be the same everywhere, and as such, if they are foreign components, the laws of that land may also apply. So it is very much important for you to understand the accounting policies of the parent, because now definitely there could be a variation between parent companies accounting policies and subsidiaries accounting policies. So if there is any inconsistency, how to address that inconsistency, what to do, all that also we are supposed to see. Not only that, determining and programming the nature, timing and extent of audit procedures, determining the NTE, nature, time and extent of audit procedures to be performed based on assessment of risk of material misstatement, in the consolidation process, and determining the extent of using other auditors work. Now this is 600. If at all did you use, now sometime back only I told you that components have been already audited by somebody, and if you want to use that work you can, and coordinating the work performed. If at all you are using the work, how much can you use, and you can follow standard number 600 for that. Okay, keeping all this in consideration, we go move further. Right, in respect of completeness of this information, the auditor should perform obviously completeness. Now you can, if at all you already used, I think these points are of very simplistic nature because you've done so many things already with respect to other audit aspects, so I don't think this will be a big problem. Let's check that if there is any new point, we'll catch up. Otherwise, reviewing the working papers from prior years, we already know this. This is a point from 230. Standard number 230 always says working papers are definitely kept for any future references. So you review the working papers for the prior years for known components, review the parents procedures, for identification of various components, who are those and what it is. Parent financial statements will disclose in the notes to account who are their related parties, and that you can check. Make inquiries to the management, which inquiry is always the best way to obtain audit evidence. So make inquiries of management to identify any new components, or any component which goes out of consolidated financial statements, Review the investments of parent as well as components, review whatever investments they made, because if the parent has made investment in some company and it is more than 51%, that makes it a subsidiary, right? So review the investments of the parent as well as the component, determine the shareholding, see what are your joint ventures and joint arrangement, because definition of component includes joint ventures also. Okay, so review the joint ventures and joint arrangements as applicable. Review the other arrangements entered into by the parent, that have not been included, in the consolidated financial statements of the group. Review the other arrangements entered into by the parent that have not been included in the consolidated financial statement of the group, and review the statutory records maintained. Review what? The statutory records maintained by the parent of, for example, registers under section 186 and 190 of the Companies Act, they are all maintained for intercorporate loans and investments, 186, right? So review the statutory records maintained by the parent to cover those sections, and identify if there are any changes in the shareholding that might have taken place during the period. You can look out for a statement of changes in equity, you can always ask for a statement of changes in equity, which will tell you what are the changes that took place in this particular case. And now important point, where a component excluded from consolidated financial statements, is excluded from consolidated financial statement, the auditor should examine the reasons for exclusion, why it has been excluded. The auditor shall examine the reasons for exclusion and whether such exclusion is in conformity with the applicable FRF. Can you exclude, like say for example, two reasons for exclusion under the Companies Act are: the relationship of parent with subsidiary or associate jointly controlled is intended to be temporary. Underline the word intended to be temporary. So where it is intended to be temporary, it always is a matter of fact that it's going to be closed very soon, so it's not a big problem. Then the subsidiary, associate, joint ventures under several long-term restrictions which significantly impair the ability to transfer funds to the parent. So when you are not able to transfer funds back to the parent, you are in some long-term restriction. These two may be reasons wherein you may not actually consolidate them. That is the point, and you are as an auditor expected to check that. Under the Companies Act, now you told that, you remember the point that we read, intermediate subsidiary in India is not required to prepare. Intermediate subsidiary, why? Because anyway parent is preparing. I gave you that example, right? H Limited is anyway preparing, so A Limited will not prepare a consolidated financial statements of A Limited and S Limited. So you don't have to consolidate. Let me tell that once again, because generally in the class most people are asking this only. So H Limited is a subsidiary, holding company of A Limited, which means A Limited is a subsidiary. A Limited has a subsidiary called as S Limited. Okay. So now when A Limited has a subsidiary called S Limited, these two consolidation will not happen because anyway H is consolidating all this. That's the meaning of this point. We already saw that, right? The auditor should also examine whether there is any change in the status of a component, whether a subsidiary became an associate or a subsidiary became a joint venture or anything, wherever any change between them. If so, whether the changes have been properly accounted for. So whether the changes, so let's say a subsidiary was there, that means we are holding more than 51%, and then suddenly what happened is we sold a little bit of stake. Now when we sold a little bit of stake, let's say I sold some 10%, I'm already holding only 52 and I told 10. So now it becomes 42. Now it's not a subsidiary. Then how are you operating? Sometimes what we do is, what is operated as subsidiary, we continue to do that, but then we will also convert it later into a joint venture or something like this. So joint venture later becoming a subsidiary, subsidiary later becoming a joint venture, all these type of things whatever are there, you got to take all of them into consideration. The auditor should also examine whether there is any change in the status of a component. No sir, no changes, cool. If so, whether the changes have been appropriately adjusted in the financial statements, so that they take due care while consolidating those financial statements, and did you adjust that properly is also something that we are looking for in this particular case. So I hope everybody understood till here, because now we are going to start the topic number 4, wherein we got to talk about what are the special considerations that we have to take into considerations. Now let's look at permanent consolidation adjustments. When you are making the consolidation for the first time, we got to make that permanent consolidation. So there are two types of consolidation adjustments. Watch this carefully. This is permanent consolidation, okay, permanent consolidation and current period. Now don't be of the impression that if one is permanent, other is temporary. No, there is nothing called temporary. Don't use your basic sense of bird. One is permanent, other one is current. I've seen a lot of people long term investment in short term. There is no short term, current, right? So like that, permanent consolidation adjustment and current period consolidation adjustments. And let's go ahead and see this one by one, and then we will go to the reporting part. Permanent consolidation adjustments, what are those? Those adjustments that are made, underline, only in the first occasion, only first occasion, that is the first time when you are consolidating. Those adjustments that are made only on the first occasion of the preparation and presentation of consolidated financial statements, like say for example determining goodwill or capital reserve as per the applicable FRF, the accounting standards, and determining the amount of minority and controlling. I hope you did problems, so you know what we are talking about in this case. So I hope, I'm pretty certain that you must have done the problems by now, and this, now that consolidation was there in Inter only, so you should be knowing how to determine goodwill or capital reserve and what is minority and non-controlling interest. So the auditor should verify the above calculations have been made appropriately, because it's the first time you're checking what those are. The auditor should pay particular attention to determination of pre-acquisition reserves. Underline the term pre-acquisition reserves of subsidiary. I think if you have solved the problems, there shouldn't be a real problem in understanding this terminology. Those of you who haven't, I think some of you who must have seen this from the old syllabus of IPCC and coming to see this, if you are not aware of consolidation, I suppose by now I think you should have already finished your FR. If you haven't finished FR, I suppose you first do that consolidation and then get here, because that gives a lot clarity, and then this chapter will be very, very simple for you. The auditor should pay particular attention to the determination of pre-acquisition reserves of the subsidiary and associates. The auditor should also examine whether the pre-acquisition reserves